Okay, it is time for our practical example. Earlier, we talked about the 5 criteria that determine whether we can register revenue. Let's describe a few regular business situations and see whether these criteria are satisfied, shall we? Yes, let's do that. Imagine you own a juice bar and you sell orange fresh, $5 for 500 milliliters. A client walks in and orders a 500 milliliter bottle of orange fresh. He hands you $5, and you accept his payment and prepare the bottle of fresh. Once it is ready, you hand it to the client, and he walks out of your juice bar. Right. Let's remember the 5 rules. Risks and rewards have been transferred from the seller to the buyer. The seller has no control over goods sold. Collection of payment is reasonably assured. The amount of revenue can be reasonably measured. Costs of earning the revenue can be reasonably measured. So, let's compare whether we've satisfied all 5 rules. This looked like a complete transaction, but you never know. Risk and rewards have been transferred from the seller to the buyer. Well, the client received the bottle of juice, and it is in his possession. So, yes, risks and rewards have been transferred from the seller to the buyer. The second rule is satisfied too. We have no control over the bottle of juice anymore. The third rule is satisfied as well. The client paid for the juice, and we can measure how much he paid us. $5. Rule number 4 is satisfied too. What about the costs of earning the revenue? What type of costs did we sustain? We had to buy oranges, a machine that squeezes them, and the cost of your time must be factored into the calculation. Nevertheless, these costs can be reasonably measured. Therefore, condition number 5 is satisfied too. Fine. Let's try with a different situation. The same bar, the same barista, and the same person walks in. However, this time, instead of a sole orange juice bottle, the client says he would like a muffin too. The standalone price of a muffin is $3. However, unfortunately, you are out of muffins. So you offer the client to pay you the combined price of a bottle of orange juice and a muffin, which is $8. And in exchange, you would give the client a coupon for 2 muffins, with which he can get 2 muffins for free. The client accepts, and you give him the coupon for 2 muffins and prepare the orange juice. Once the juice is ready, the client receives the bottle and walks away from your bar. Please remember that the price of a coupon for 2 muffins is $4. Okay, perfect. Are you going to recognize revenue in this case? And if yes, how much? The situation is more complicated, isn't it? We'll have to take a careful look at the 5 criteria for revenue recognition. The first criterion considers whether risks and rewards have been transferred from the seller to the buyer. Well, that happened only partially, right? The client received a bottle of juice, but he received no muffin. The risks and rewards related to the bottle of juice have been transferred, given he received it. However, the 2 muffins coupon given to the client isn't an actual product. Let's look at the second rule. The seller has no control over the goods sold. This one is only partially true as well, right? The muffins haven't been delivered. Therefore, it is you, the seller, who has control over them. On the other hand, you don't have control over the bottle of juice. Collection of payment is reasonably assured. That's true, the client paid $8. And the amount of revenue can be reasonably measured is satisfied as well. We know how much the client paid, $8. It shouldn't be very difficult to measure the costs of earning the revenue, given your bar sells these products frequently and have a certain cost of the ingredients you use to produce them. So, we've got an issue with criteria 1 and 2, right? They were satisfied only partially. The entire job has been carried out only partially. How much revenue, if any, should we recognize? The entire amount of $8? Nothing? Or perhaps somewhere in between? Well, given that the first and second criteria were satisfied only partially, we'll recognize revenue only partially. A 2-muffin coupon costs $4. The client paid $8. We still owe him the 2 muffins, and we gave him a coupon. Therefore, out of the $8 he paid us, $4 can be recognized, and the other $4 should be registered as a prepayment, accounting-wise. We can't recognize revenue as conditions 1 and 2 were not satisfied. What a great exercise this was, right? Now you've seen how revenue recognition criteria work in practice, too. Excellent work.